For those of you who don't know, my name is Alex Wilson, owner of Remax Wealth Builders Real Estate, and I wanted to talk to you about the Savannah Townhomes in Calgary, as well how we propose this in a cash flow offset method. So, myself, as I said, owner and broker record of Remax Wealth Builders Real Estate. Been selling real estate in Toronto for over 12 years. Number one agent for transactions in Ontario in 2019. Number 13 agent in Canada for production. That's over 15,000 agents in 2020, and number 30 worldwide. Inducted of the Remax Hall of Fame and award of the Remax Lifetime Achievement Award of 35. All of this completely irrelevant to you. What I do want to tell you about and what is relevant to you is how I turned an initial deposit of $39,300 into a $14 million real estate portfolio, and that includes 14 condos, a high park triplex, and an apartment building in Hamilton. And I always like to go over this at the beginning, so some of my repeat guests may have heard this before. But why I show this is this just shows you the value of real estate over time. So number one, here's everything I have in my portfolio, all the properties, and the current market value of those is just under 15 million. But what's really eye-opening is the value of these in 30 years. And that value is $36 million. And why 30 years is relevant is that all these properties will be paid off in 30 years because there's a tenant in the property consistently paying down my mortgage amount. And why is it worth 36 million? Well, I applied a simple 3% compounded annual growth rate. So what that means is every year I expect my property to go up by 3% in a small conservative number. And also while that every year that goes by, my mortgage, the amount outstanding in the bank goes down a little bit. And where that gets really exciting is, first of all, I look at, well, $36 million, we got that nasty word about inflation. So what does $36 million in 30 years actually mean? Well, what it means is that $36 million is actually nearly $21 million with today's purchasing power. And then if I go a little farther, I'm like, well, what does a fully paid off portfolio, remember in 30 years, I have no mortgages. The tenants have paid off all my mortgages. So what does $21 million mean? Can I live off of that? What does that provide me in regards to an income stream? Well, if I use a simple 5% rate of return, which is conservative, most people look for a 6 to 7% rate of return. I'm just, let's just look at 5. Let's keep it easy. Well, those tenants over the 30 years have provided me with this portfolio that's completely paid off. And if I'm looking at a 5% return on those, who knows what I haven't invested in at that point, it's going to give me a yearly payout of over $1 million. And if, again, that nasty inflation, so let's reinvest 2% of that. So that means I could live off of $624,000 per year. My portfolio is inflation protected. That means I can pass it on to future generations so they can have those payoffs every year. And those people living in the roofs that I provided them have provided me a very, very comfortable living. It's a long game real estate, but can provide substantial wealth over time. We're not looking for short-term gain. We're not looking for short-term satisfaction, instant gratification. It's not a game of instant gratification. It's a long game you play over time. And that number that when I showed you the portfolio, you'd be like, well, Alex, that's a daunting number. Like, how do I come to a $15 million portfolio? The thing is, you don't need to come up to a $15 million portfolio. So what I've done here is I've broken it down into bite-size amounts. $1 million portfolio, a $2 million portfolio, a $3 million portfolio. And those numbers may seem big, but to, let's say, $400,000 properties, that's a $1.2 million portfolio, right? So it's not very hard to get up to these numbers because what you're using leverage, using a mortgage, other people's money to buy these assets, and then you have someone else paying down these properties over time. That's the key currency. Time, not dollars. Time is the key currency that makes you money throughout this whole process. So if we look at $1 million portfolio, well, in 30 years, that is going to give you, in today's purchasing power, a $70,000 annual salary, or as I recommend, only taking 3% out, a $42,000 in today's purchasing power salary. So this is, you're securing your future retirement by investing in these properties, which is really, really exciting. So let's go on to the how you can do this. You're like, well, Alex, how do I start doing this? So when I put this presentation together, I'm like, you know what, a great line for this presentation is use your home to create a pension fund. Because that's essentially what we've done, is we've created a pension fund. We've created a portfolio that's going to provide us with an income in the future, which is what a pension fund is. The great thing is you control this pension fund. And what we're going to do is we're going to use your house, your current house, to fund your retirement, but you get to keep your house. So instead of looking at, oh, my house has gone up in value, that's great, I'll sell it and I'll sell it in the future and I'll live off that. You don't need to. You can keep your house in retirement if you use these steps. So it's great that your house has probably gone up a lot over the last year and a half. But the only way to access those funds is if you sell the house. But if you sell the house, then you have to go buy another house and you have nowhere to live. So unless you're going to a market that's worth less than yours, then you're not selling your house. You can't use those funds. But what you can do is you can leverage the existing equity now to fund your retirement. So when we look at these townhomes, each of these townhomes, it's actually more than $23,000, so that updated the numbers. But each townhome represents over $23,000 of annual income in your retirement years. And it's just simple math, and I'm going to show you now. So own your home, buy a condo. This is strategy one. So you use a home equity line of credit off your primary residence. So these townhomes start at $389,900. They're 3-bedroom towns with a den, 1,570 square feet. So $389,900. You get to purchase them with an initial 10% deposit. But when you go get a mortgage, you still have to put 20% down. So we run these numbers at 20%. So we put 20% down on these properties. So a 20% on $389,900 is $77,980, and the monthly interest on that is $191. So when I look at $191, which is my monthly interest for the deposit, when I look at the Savannah town, the purchase price is $389,900, so the mortgage on that is just over $1,100. The maintenance fee, the property tax, so the monthly running cost on that is $1,536. But the rent I'm getting on it, which is guaranteed, by the way, which the builder is going to lease back the unit from you for 3 years for $1,950, including full property management. So you're getting $1,950 per month from the builder. So that means when I subtract $1,950 by $1,536, my running cost on the property, I'm getting positive cash flow for $14 per month. Plus, remember that little thing that I talked about, that principal payback, that the fact that your tenant is paying down your mortgage every month? Well, every month they're paying $660 down off your mortgage. So your cash flow plus your principal payback is over $1,000 per month. But the beautiful thing is, if I look at my interest expense, which is $191.70, so that amount which I've been running off my house, which is tax deductible, by the way, against the income coming in. So that $191.70, I'm getting positive cash flow of $414.03. The combined cash flow between the two, I'm still positive by over $200 per month. Over $200 per month, and that's guaranteed because the builder, from a revenue standpoint, the money coming in, that $1,950, they're paying that for the first 3 years. You don't have to worry about a vacancy expense. You don't have to worry about finding a tenant for the first 3 years. the builder is going to pay you $19.50 per month. And that is going to cover all the costs to run the property, the mortgage, the maintenance fee, the property tax, plus cover the cost of the deposit running the home equity line of credit off of your property, and you still have some extra money left in your pocket. So you've used none of your own money, and you've acquired an asset that's going up in value at the same time someone is paying down the mortgage on that property. And here's where it gets really, really fun. Okay, so remember, real estate is a long and boring game. We're not looking for instant gratification. So what's this property worth in 30 years? So if I plop it down in my Excel spreadsheet, at a 3% compounded annual growth, it's worth just under $950,000 in 30 years. So if I do my inflation adjustment, so what does that mean in today's purchasing power? That means $555,000. So that means and that's $555 clear. There's no mortgage. That mortgage has been paid off by the tenants over the 30 years. This is not factoring in any positive cash flow, just keeping it nice and simple for everyone. We apply a 5% rate of return on that $555. That's going to give you an annual income of $27,000 per month, nearly $28,000. That is income into your retirement or for your future generations or your financial freedom, whatever you want to do. You have secured that income for your future. You have used the existing equity in your home, and someone else has been covering the expense the entire time, your interest expense off the home, as well as the mortgage, and that's been paid down the entire time. Let's go to another level. Let's say you don't need to use your home equity line of credit on your home. You have funds that you're looking to invest. And you like Toronto, but your biggest issue in Toronto is like, oh, Alex, if I invest in Toronto, most likely I'm going to be running negative cash flow. So what negative cash flow means is if I put a standard 20% down after my rent, when I subtract mortgage, maintenance fee, property taxes, I'm still going to have to put more money into my bank account every month to cover all the costs. So what you can do is what I call, this is where the cash flow offset comes in. So if I want to invest in Toronto, but I'm concerned about negative cash flow, then I find an area where I can invest, where I can get positive cash flow, which is going to offset the negative cash flow in Toronto because I still own a Toronto asset. So condos, for example, which is a development in downtown Toronto, a one-bedroom, 433 square feet. That's going to cost you just over $690,000. So when I looked at the running costs on that, with an expected rent of $2,300, my cash flow, I'm going to be negative just under $325 per month. I'm still positive on my cash flow plus principal payback, because remember, every month the tenant's paying down the mortgage. So I'm still gaining there. But if I add in the equation a Savannah town, so basically between these two, we'd be looking at about an investment of about $180,000 between the deposits for prime condo and Savannah town, about $40,000 for the $200,000. Sorry, $200,000 for the Savannah town and prime condo. If I invest in both of these, so my prime condo and then get my Savannah is $389,900. We know that we're going to be running positive cash flow of $414. Let's run the math. So I'm running negative $324 on the prime condo, but I'm running positive $414 on the Savannah town. So the combined cash flow is positive $89 per month. So now I'm not worried about the monthly expense of the Toronto condo, because I've offset that by the positive cash flow of the Savannah town. And then when I go back to my value in 30 years, no instant gratification, long and boring game. My Savannah condo, as we talked about before, that's worth $946. My prime condo, that's worth just under $1.68 million. If I adjust for inflation, that's 1.5, just over $1.5 million. So my expected rate of return on those two combined properties is $77,000 in 30 years. So at a combined income of $77,000 per year that I'm going to be securing for myself in the future. So I've turned that $200,000 today into a payout of $77,000 per month, not per month, per year, every year in 30 years. So we've created a model where, okay, if I'm running negative in Toronto and I run into a situation where I've lost my job or things are getting tight, I'm worried about the monthly income stream, I'm okay because I have this other property that's covering that shortfall on the property. You never lose money in real estate unless you sell. So never put yourself in a situation where you have to sell. So by using the cash flow offset method, you're able to still invest in the Toronto market, but not get into the danger of running a negative portfolio. So why Calgary? Well, I started investing in Calgary in 2019. And what attracted me to Calgary, we had these low price points, these low deposit structures, and being able to secure a fully managed turnkey property with a rental guarantee from the builder. So this was something that was attractive to me. And when I looked at the pricing, it reminded me a lot of the first condo I bought in Toronto in 2012, with that deposit of 39,300. So I started investigating the Calgary market. So these were all surprising figures to me. I didn't know this when I started investigating. So it was the number one most livable city in North America for 2 consecutive years, fourth most livable city in the world, top 5 on the Economist Intelligent Unit's Global Livability Index for 10 consecutive years. Um, it is located in the foothills of the Rockies, loads of green space, second lowest cost of living of Canadian cities. And remember, this is the base of the Canadian Rockies. It is absolutely stunning if you've been to Banff. Um, the sunniest city in Canada, so substantial sun in the area, the most extensive outdoor bike pathway in North America, and ranked second for healthiest lifestyle. So you get this great city, great satisfaction living in the city, a great healthy lifestyle in the city. I'm like, this looks like a pretty good place to live. And then, of course, we have Banff, which is just on the outside of the city. 5 world-class ski resorts within 2 hours, over 200 hiking trails in Banff National Park. And it's only an hour and a half drive to actually get to the national park. And this is a true hour and a half drive. This isn't like going, hey, I'm going to get to Muskoka, north of Toronto, in 2 hours, but I got to leave at 4 in the morning for that trip to be 2 hours because everyone tries to get out of the city in the weekend. No, this is the real 1.5 hours. There isn't traffic situations like we have here. So on the surface, I'm like, this looks like a great place. Let's go deeper down. Well, we're in the business of investing in roofs overhead. So first of all, if I'm going to invest in the city, I want to make sure that the population is growing. So I did my research. Net population growth of 46,000 people in 2019. 44,000 people in 2020. They've already grown by 34,000 people in 2021. So we're seeing the population growing in a positive trajectory in Calgary. From a financial standpoint, because A, I want to make sure that the population is growing, and B, I want to make sure that the population has the money to pay for the properties, to pay for the rent, to pay for future property appreciation. Well, Calgary has the highest millionaires per capita of all the major Canadian cities, and Calgary represents the highest wages and salaries per employee in the country at over $66,000. So I have positive population growth, and I have the highest salaries in Canada. So then I look deeper. Let's look at that population growth under a longer term period. Because remember, it's all a long and boring game. Well, this is from Stats Canada. This blew my mind. So in 2 decades, the population of Alberta is going to grow by 48%. Compare that to Ontario. Ontario is only going to grow by 24%. So it's going to grow at double the rate of Ontario. And the net population swing between Alberta and British Columbia, its neighbor, is over 1 million people. So currently, Alberta has 600,000 less people than British Columbia. In 2 decades, it's going to have 400,000 people more. So we're investing in a province which is going to have the strongest population growth in Canada, double the rate of Ontario, and it's going to have 1 million more people than its neighbor, British Columbia, in 2 decades. That was mind blowing for me. Absolutely mind blowing for me. And then when we look at again, those are the roofs over the heads. Let's look at the numbers. Well, we got our big three. So in population size and GDP, Toronto, Montreal, Vancouver. That's your 1, 2, 3. Well, what's number four? Number four is Calgary. Number four, Calgary has the fourth largest economy in Canada. Its economy is larger than the economy of Manitoba and the economy of Saskatchewan. So we're dealing with a city that has a larger economic impact than whole provinces in this country. So we have a very strong economic footprint, and we have the fastest growth rate in Canada over the next 2 decades. So I'm getting interested. Plus, we talked about it, it has the second lowest cost of living in Canada for all major Canadian cities, which we're going to get into more. So let's talk about buy low and sell high. So you may be going, Alex, well, this sounds all great. Well, why are prices so low in Calgary? Well, Calgary, in 2017, you had a falling out on the oil prices in Calgary, and this led to massive layoffs in 2017. Which, when you have massive layoffs, that's going to have an impact on your real estate market, because you're going to have a shock to the supply. When people are losing their jobs, they're not buying, and you have probably more people that are selling their homes at that time. So an increase in supply, a decrease in demand leads to lower prices. And we actually saw new condo prices drop by 21% since 2017. And I also like to put this line, Warren Buffett, buy low, sell high. And he actually bought a pipeline during the pandemic. And his philosophy is, you buy when it's low, you sell when it's high. And that's what we're doing in Calgary. When I look at the growth projection stats from a population standpoint, and we're going to go deeper into the economic footprint of Calgary, things get really exciting. So we've seen the prices drop in Calgary, and the reason for the drop was oil prices fell, layoffs happened. But all the layoffs are done. That happened in 2017. These companies are running efficiently now. So you're not going to see any more layoffs. Now we're in our recovery stage. Calgary is typically boom and bust. Number two, and what I want to point out, is that we have the Trans Mountain Pipeline. So the issues in Calgary on the oil side, which is, by the way, I'm not that concerned about oil. That's not what I'm basing my investments on. We're going to get more into details on that. But we need to talk about it because that's going to be the backbone of the economy moving forward. We're not looking for growth in oil and gas. We're looking at it as a backbone. But during the pandemic, we saw Alberta oil selling for 50% less than Texas oil. Why is that? Well, the issue with Alberta and its oil is that it's landlocked. You can't easily get the oil out of Alberta. So your largest customer is the Americans to the south. What the Trans Mountain Pipeline, which as Canadians we all own because the federal government purchased it, the Trans Mountain Pipeline is scheduled to complete in 2023. What is that's going to allow us to do is export our oil to other markets, overseas markets. Our oil, when prices go down, we're more significantly impacted because we only have one customer. The U.S., for the most part. The U.S. is our largest customer for our oil. Now, you may be all going, well, what about Keystone? That was canceled. Isn't that a big economic impact? Has absolutely no impact. Why it has no impact? Well, Keystone was already canceled in 2015. And because it was canceled in 2015 originally by the Obama administration, there were other pipelines where capacity was increased because Keystone was just going to the U.S. That's all it was doing. So it was just supplying more oil to our largest customer. And because it was canceled in 2015 already once, the capacity needs were already met on other pipelines to meet the future growth in the American market. So we have enough capacity currently right now to service the market, and we have enough new capacity coming online to service the growth in the American market into the future. So we don't need that. Keystone was just going to be excess capacity going to the US market. What we need is going to the international markets. And that's where we're going to have our oil capacity tripled on the Trans Mountain Pipeline and international exports increasing by 13%. So that's going to help our oil price on the international level. And that's what the key thing is. It's a distribution issue with our Canadian oil. And that's why Trans Mountain is so important. It doesn't have anything to do with the Keystone. Not irrelevant. It was just going to create construction jobs. It wasn't going to have an impact on the oil distribution. It's the international markets that we want to take advantage of. That's the distribution of the oil. Now, the oil is what Calgary was built on. And the oil is what built up the downtown core. So you may read articles on the downtown core of Calgary. You have record vacancy levels, 20% vacancy rate in downtown Calgary. Again, the reason for that is a lot of these construction projects happened in 2014 when oil was over $100 per barrel. So you had a rapid building in downtown Calgary. They overbuilt offices. So you have record level office vacancies because you built too much. But this is great. Why this is great is now you have low cost office space, which can allow other industries to come in and have a lower cost basis to work off of. So Calgary ranked in the global top 10 most attractive cities for workers. Calgary has the highest proportion of STEM graduates of major Canadian cities, degrees and programs in science, technology, engineering, mathematics. Well, guess who needs those jobs? Technology companies. They need those students. So those STEM graduates are what they're looking for to employ. And because of the low cost environment, Calgary is now home to 435 technology companies, and 3/4 of them are startups. There are more than 2,000 open tech jobs in the city, and over 44,500 Calgarians are working in tech right now. And this is where we see the difference. So when I compare the average office space, which is $17.50 per square foot, when I compare it to Edmonton, Edmonton is 23% more. Toronto is over double. Vancouver is over triple. So I can get Calgary office space for significantly less. So if I'm a startup, which I'm cost sensitive, I can operate at a much lower level, expense basis wise, by operating in Calgary. And we're seeing the results of that. So the stuff I'm saying, I'm not making it out of thin air. I give concrete examples. So we're seeing a significant level of unicorns and investments starting to hit into the Calgary market. So another Calgary unicorn as a tech firm, Benevity, sells major stake for $1.1 billion. So Benevity, you look at the data article, December 4th, 2020, got a $1.1 billion valuation. That's what a unicorn means. You have over $1 billion valuation. The Benevity deal is big news for Calgary. It matches other unicorns that happened over the last couple of years. We have Solium Capital, which sold to Morgan Stanley for $1.1 billion in 2019. There's a $1 billion deal between Calgary-based medical research firm Parvis Therapeutics and San Francisco-based biotechnology company GeneTech that same year. You have positive momentum happening in the technology space, in the startups in Calgary, but there's other companies coming. But just in the startup field alone, what happens in the startup field is you get these unicorns. So you get $1 billion plus valuations. Two things happen. Number one, you have the founders. So the founders of these unicorn companies, they're flush with capital now. And they know that in this 435 company environment, 3/4 of them startups, their friend over there, like, that guy's got a good idea. I see big things. He needs some capital. I'm going to invest some of my capital over there. So then you have kind of a self-fulfilling prophecy with the founders of those companies reinvesting with companies that they know in their environment. Plus, now you have venture capitalists, private equity firms are going, oh man, I want to get in that action. $1 billion unicorns are coming out of that city. I need to fly down a team over there. I need to start investing in there. I need to find what the next valuation is. I need to put my investment capital to work. So then you have the money flowing into Calgary. More jobs, more jobs, more jobs. And let's talk about those more jobs. So SciMed, An example, another technology company had fewer than 20 employees in the spring of 2020. Now it's more than 200 employees, moving into 79,000 square feet and looking to hire an additional 200 to 300 people in 2021. Office space in Calgary. Halcyon officially grew its cramped office space in Blackfoot Industrial Park, gone from 3 staff to 68 employees over 5 years. Plans to have 150 employees by the end of 2021. They signed 20,000 square feet in the Millennium Tower in downtown Calgary. LodgeLink will require 300 new technology-based jobs over the next 5 years in Calgary. Will require an additional 50,000 square feet of office space in Calgary. But it's not just the startup firms. We have international companies which are now looking at Calgary. CloudExa, ESQ's new Canadian subsidiary, they looked all over Canada and they decided to make Calgary their location for their head office. And they're going to be opening a new head office in Calgary and bringing in jobs. InfoC, a huge technology company out of India, are going to be bringing 500 jobs to Calgary in March 2021. Mphasis, another massive global India-based IT company. Well, guess what? 1,000 jobs going into Calgary. They're opening their Canadian head office there. And it's not just the internationals. This was just announced last week. Google this, July 21st. RBC bringing 300 new tech jobs to Calgary Innovation Hub. RBC looking to create a technology ecosystem in Calgary through work integrated learning. So our local companies are opening offices in Calgary. And why are they doing that? Well, this has already happened in the US. So I've already seen this happen in the US, and that's why I know it's happening in Canada. When we look at our Vancouver and Toronto markets, they're very, very expensive. As we said, office space is 3 times more in Vancouver, 2 times more in Toronto, and we know of the affordability issues for workers in both Vancouver and Toronto. Very, very expensive cities to live in. But also from a tax basis, well, guess what? Alberta has the lowest corporate tax rate in Canada, and there's no provincial sales tax. What is this very similar to? Well, what we've seen in the US is we're seeing companies move away from California, which is one of the most highly taxed states and one of the most expensive states to live in, and move to Texas. Why are they doing that? Fleeing high taxes. Well, as I said, Alberta has the lowest corporate tax rate in Canada. There's no land transfer tax or development charges in Alberta. There's no provincial sales tax in Alberta. So Alberta has the lowest tax environment in Canada. Expensive housing. Calgary housing, second lowest cost of living out of all major Canadian cities and 9th in North America. Limited red tape in Alberta. So we have a low tax basis to work off of, lowest tax base in Canada to work off of. We have a low cost of office space in Calgary. Plus, I may have a technology worker who's making $100,000 a year in Toronto or Vancouver. That doesn't get them very much, and maybe they're sleeping on a friend's couch because they can't afford anywhere else to live, or they can live in Calgary and have a much more comfortable space and go play in the Rocky Mountains on the weekend. Plus, the government, and we're going to get more into this, the government regulations. So, as I said, when the pandemic hit, Alberta slashed its corporate tax rate because it has the lowest net debt per capita for individuals in Alberta. I'm going to show you that slide. Plus, they created a $175 million fund commitment to the Alberta Enterprise Corp for innovation. And also for you investors, there's no rent control in Alberta either. So we have a government that's making investments to attract new industries to its province. And it's already happened in the US. So we know that we've seen companies move away. And let's talk about those companies. Hewlett-Packard, 60,000 employees worldwide. They moved office space to Texas. Oracle, 135,000 employees worldwide. They moved office space to Texas. Tesla, 48,000 employees worldwide. They moved office space to Texas. Dropbox, we all use Dropbox. 2,800 employees worldwide. They moved office space to Texas. The same thing, and we're already seeing it, is going to happen in Canada. And why can Alberta make those types of investments? Why can they cut their corporate tax rate? Well, remember where I said oil was the backbone? It used to be the growth driver, but I'm just looking at it as a backbone. There's a revenue stream that comes from the oil development. And because of those oil royalties all over the past years, when we look at the net financial debt per resident of Alberta, we're floating in under $2,500. Versus if we look at Ontario, that's nearly $19,000, and the rest of Canada is over $10,000. So Alberta is going to grow the fastest level of net financial debt per individual. The growth rate is going to be the highest, but that's because they've saved. They have the capacity to make those investments, to slash corporate tax rates, to make it, to give grants, to make investments in innovation funds, to bring new industries in, because of, look at their low debt levels. The other provinces don't have those abilities. So yes, they're going to grow, their debt levels are going to grow very quickly, but they're supposed to. They can make those investments. So that's why I'm very excited about Alberta. And we're looking at low taxes, fastest population growth in Canada. We're buying at the bottom of a market, and that's posed for the recovery because we're already seeing the new technology companies move in, and we have a government that's making investments to attract these companies to come in. And it's a pro-investment environment. So no rent control, as I mentioned, no foreign buyer tax, no land transfer tax, no provincial sales tax, no development charges, and a $10 billion stimulus package, which has already been signed in, which has reduced the corporate tax rate. And we've been preaching this message since 2019, and it's happening. So ERA was the first project that we sold in Calgary. That sold out in 3 months, 180 units. ERA 2, which came in March, we sold 40 units in 2 weeks. East Hills sold out 87 units in 2 weeks in November 2020. And East Hills 2, we sold 184 units just in May. York Towns, we sold out 100 units in 1 month in June 2021. This is the sister site to Savanna Towns, which we have today. So Savannah Towns, as I mentioned, the sister site to York Towns. 3-year lease back with full management. So what that means is the builder is going to lease back the unit from you from day one, and that's going to include full property management. So you have a guaranteed income stream coming in, and no one's going to call you at 2 a.m. in the morning that their toilet's broken. Fully turnkey solution. These are 3-bedroom plus den townhomes with 2-car parking and heated garage. How much would that cost you in the GTA? I'm bringing you to the boonies, and it's still going to be over $900,000. These are going to be between $389,000 to $399,000. They closed late 2022, and the deposits are only between $38,900 to $39,900. So under $40,000, broken up into 2 payments, one in 10 days, one in 90 days, and they're cash flow positive over $300 per month. So what I'm going to do, I'm going to stop sharing the screen, and I'm going to open the floor to any questions you guys may have. So I just noticed there's one right here. Hey, Alex, I started watching a few minutes late. Just out of curiosity, what interest rate and down payment are you using to arrive at a monthly mortgage payment of $1,122 for Savannah Town? Yeah, great question. So what we're doing is the deposit is 20%. So whenever you're buying an investment property, you have to put 20% down, and the interest rate I'm using is 1.8%. I can tell you right now, in the last month, I signed mortgages for 1.35% and 1.4%. So I'm confident that we are still going to see low interest rates into late 2022. So that's why I did a 1.8. But I personally signed 1.35 and 1.4 just last month on the mortgages. So how it works is when you buy pre-construction, you put a deposit down with the builder. And the deposit structure for this one, it's 5% in 10 days and then 5% in 90 days. That covers you till you get the property, which would be late 2022. when you get the property in late 2022, when you go get a mortgage on the property, you are going to have to come up with an additional 10% to get the mortgage on the property. So that's where you got to factor in that additional 10% in late 2022 to get the mortgage on the property. Okay, great question here. When there are so many positive factors with Calgary, then why are prices so low as compared to other markets of Canada? Well, the reason is it's just coming off of a down market. So oil prices fell out of the Calgary market in 2017. So prices went down in Calgary for a number of years. So a lot of people are gun shy because they saw prices go down. The number one question I get about Calgary is like, well, how much does it go up per year? Because that's what people usually ask in Toronto, because people are so used to investing in Toronto. So in Toronto, you're investing up, you're keep on climbing the ladder, going like this, investing higher, 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 higher. Where now I can't get you positive cash flow. That no longer exists with a typical 20% down payment. So now you're just hoping for appreciation, hoping for appreciation. In Calgary, well, in 2017, prices went down like this. And I've seen prices level off. And now I'm seeing prices slowly start going up. But guess what? I'm getting positive cash flow. I'm getting positive cash flow over $300 per month. So what I'm getting is I invest there, I get my positive cash flow, and then I wait. And then I wait for the market to come back up in value. Why did it go down? Well, oil prices went down. Layoffs happened. They went from $100 down to $60. So companies cut jobs. All that cutting is done, and we have new industries moving into the space. And that's where we're going to see prices go up. I know that population is growing in the city. I know that population is in Alberta is set to explode, and the population is going to grow by 48% over 2 decades. I know that companies are getting billion-dollar valuations, that international companies are opening offices in Calgary because of its low-cost base. I know with all of that, that prices will go up. And while I wait for prices to go up, I'm going to get $300 per month. Oh, back to the questions. Hi, where is this located in Calgary? Near downtown. So these townhomes are located in the northeast quadrant of Calgary. They are located in the city of Calgary, in the northeast quadrant of Calgary. You are all going to get information on these. These will be emailed out after this call, as long as you're on my email list. If you want to make sure you get the information, you can just send me a message in the chat with your email, and I'll make sure I message you directly. I'll also put my email just in the chat here, just in case someone wants to send me an email, but you should have it all in your inbox if you're attending this webinar. There we go. But yeah, these are located in the northeast section of Calgary. And what they're located right off of the ring. So the ring is a highway system that goes right around the city of Calgary. So you can easily get onto the ring and get anywhere you need to get to in Calgary. Joe, I tuned in late as well. Are you going to send a replay link? And are you investing in Calgary as well? Yes, I've been investing in Calgary. I own 3 properties in Calgary now. My sales team, they have bought in this development. So yes, we are actively investing in Calgary. I personally have 3 properties. My team is buying in this development. So yes, we have exposure and we are investing, because I can't get you these prices I can't get you these prices in the GTA. I can't get you these prices in Ontario. And that's really what it is. And when we started selling Calgary in 2019, people are like, "Oh, this looks interesting. I'm gonna buy there. The pricing and the analysis look good." Now what I'm getting is I get people buying, going, "Hey, Alex, I really like investing. I'm a seasoned real estate investor. I want cash flow. My properties always have the cash flow. I've looked everywhere in Ontario. I don't like anything in Ontario anymore. I've looked out east. I can't see anything out east. The argument for Calgary is just too overwhelming. I'm going to be investing in Calgary." So what we've come from is the kind of speculative buyers that are kind of buying into the dream in 2019 to the actual hardcore real estate investors going, "Hey, I see some great opportunity here. That's where I'm going to be going now. That's where I see things happening." Oh, by the way, There is no foreign buyer tax in Alberta either. Great question here. How do we manage it remotely? The great thing is it comes with full management. So for the first 3 years, so when you get the property in late 2022, maybe early 2023, you have 3-year rental guarantee. So from 2022, you have that guaranteed revenue stream coming in. And then every month for the next 3 years, the property is fully managed for you. So you're not really worried about the asset in really until late 2025, early 2026. And then at that time, remember there's no rent control in Calgary. So if the rent is higher than what you're currently getting on the property, you can increase the rent on the property. And then you can continue to pay the management company that's managing the property for you. Or I will have other solutions for people out there. If you're looking at what expense, you're looking at about a 10% fee on the monthly rent for your management. But again, you don't need to worry about that until late 2025, early 2026. And here's another question. Is there any cost for the first 3 years? No cost for the first 3 years. Just what you're looking at is you're getting the revenue stream. These are set at $19.50 per month. So your rent, you get $19.50 per month every month. Any additional costs other than your mortgage, maintenance fee, and property tax? No, you don't have any additional costs. Maybe if you want, if you're securing insurance on the property, there'd be the insurance cost, but that is much lower than the insurance that's going to be on your property, your principal residence that you live in. But there's no management costs for the first 3 years at all. Any other questions from anyone? So as I said, as Joe asked, this has been fully recorded. We will send you all a replay of this recording. You'll get that within 24 hours, and you'll have full details on the Savannah towns and what's available. We expect these to sell out quickly. Here we go. Just want to check. These are 3-story townhomes with 1 garage. Yes, 1 garage for 2 cars. So there's two cars that can fit side by side in the garage. You'll see the floor plans in the email that I sent out. But yes, you can fit 2 cars. It's heated in the garage. And some more questions. What is the property management cost after 3 years? What I've been seeing is about 10% per month on the monthly rental. Maintenance fee will include your general maintenance of the area, also contributions to the reserve fund, so for your windows, roof, and those kind of things. Is there a 10-day cooling off period for a lawyer review? Yes, there is. Can we speak when you have a minute later? Yes, we can. Got your number there. Let me just write that down. Perfect. And I think I answered all those questions there. Does anyone have any more questions? Otherwise, I'll wrap this up. And I'll send you guys all the details. Oh, yeah. When is the occupancy? Late 2022. So we're looking at about 15 to 16 months. Could be longer. But safe to say late 2022. Maybe you'll flow into 2023. But we'll say that. Is home insurance mandatory? I always recommend getting it. I have it for my properties. Your tenant will have insurance as well for third-party liability. But you always want to protect against worst case scenarios. So I'd recommend getting it. That's for people that are wondering, should I get insurance for the property? I would say yes. I'd recommend getting it. The project is located in the northeast of Calgary. So these are townhomes, condo towns, 1570 square feet, 3-bedroom plus den on the main floor, with a 2-car garage. So the northeast section of Calgary. Again, if these were in the GTA, these were in Oakville, let's say, these would be over $1 million for what they are. So I'm going to wrap this up now. Again, everyone will get an email out about this. I grabbed the numbers. Some people wanted me to give them a call, so I wrote their numbers down. I'll give them a call this afternoon at some point. But looking forward to sending this information out to everyone. And no, there's no basements in these. But it's 1570 square feet of living space. And what I like with the den, which is on the main floor. Now I have young children, and during the pandemic, you can't work with kids in the house. But what's attractive to me is with the den on the main floor. On your second and third, that's your living space. So second floor, that's where living room, kitchen, dining room is. Third floor, bedrooms. Main floor, got my den or a fourth bedroom. But what it is, it's on the main floor. So I'm separated away from the living area. So when you need to work from home, which will be a reality post-COVID, you have a nice separated office space away from the family. Deposit structure is 5%. So under $20,000 in 10 days, another 5%, so under $20,000 in 90 days. So a total of $40,000 or just under $40,000 in 90 days. Yeah, just 10%. So how much total deposit required prior to closing? Under $40,000. You're welcome, Joe. So I'm going to wrap this up now because I do have a call coming up at 1 o'clock. Again, if you have any questions, just send me an email, contact@alexjwilson.com. That's contact@alexjwilson.com. And there will be a recording of this sent to everyone. Thank you so much. Talk to everyone later. Bye-bye.